G'day and welcome to this video. My name is Robert Goudie, and this week I'm going to cover off on dividends and why they are important and why they shouldn't be your sole focus when making a decision with regards to your investing. Now, I get many people in the office here that say, look, I'm retired, I need high dividends, and my comment to that is you just need high quality businesses, and dividends, assessing them in isolation to other factors is a bit of a blunt tool. But let me go through and just show you some of the information that I look at. And the question that I got on a different social media channel was, I was advocating that we should be investing globally, and the ASX 200 is quite concentrated into materials and financials. But of course, to get diversification, we're talking about going overseas. So let's go and have a look at some of the things that I've been thinking about, and just to show how important it is to be diversified globally and not just solely focus on dividends. And if we only solely focus on dividends, you would have 4 banks and Telstra and a handful of infrastructure funds, but you'd be missing out on potentially a lot of opportunity out there. So let's go and cover off and compare. This is the MSCI Global Share Index. So this is global shares. 70% of this index is sitting within US, and we can see over the last 5 years the distributional income is 2.7%. Looking at the S&P, the Australian Share Fund S&P 200, and we can see there that the distributions is, which is highlighted, 4.5%, and on average there's probably franking credits there of around 80%. So let's add an extra 2% for franking credits on top of that. So we're talking 2.73% compared to nearly 6%. So there's pretty decent gap there, that from a income point of view, Australian shares look fantastic and the franking credit system looks really good. But if we then go and have a look at, well, what's happened over the longer term. This is the NASDAQ and the returns over the last 10 years, and this is just looking at the growth only. And obviously we've had a good run in markets. We can see in this picture on slide 1 that the growth over the last 10 years is just under 290%. And when we go and have a look at slide 2, where it looks at the All Ords over that same time frame, it's 45% growth over that same time frame. So over 10 years, if we say, right, there is 3% extra percent income that comes in, well, that's 30%. You are still missing out. There's a huge gap between, say, the NASDAQ and the All Ords. And of course, very different indexes. We've got very different, as I said, we've got a lot of assets in that S&P 200 within big banks in financials and resources, where in the NASDAQ and the S&P 500, the American market, we are talking about really scalable businesses like Microsoft and Apple and Google that that have crossed borders and are global businesses. So we can see that we do need to be diversified, and this is why dividends are not the sole tool or instrument we should be looking at. Now, if we go and have a look at, break this further down at a couple of businesses, the Telstra share price, we can say over the last 10 years, and obviously these are different points in time, it depends when you buy as to how well you do, but looking at Telstra over the last 10 years, it's lost 81% of its value. CSL over the same time frame, it's up 3-fold, so it's gone up by 320%. And now these are excluding dividends, so obviously we need to add some back to Telstra, but chasing a high dividend doesn't mean you're going to get a good business, and I don't think Telstra is a good business. And this is having a look at some of the dividends that Telstra provide. Now, Telstra at the moment is providing a 4.5%, essentially a fully franked dividend, so that's really a really good dividend, fully franked, which gets you up to probably 6.5–7%. So that's really healthy. But we know that it's gone down in value over the last 10 years, which doesn't make it a great long-term investment. But you can see here that whilst it's paying out 4.5%, it's payout ratio, which represents for every dollar they make, how much of that dollar are they paying out as a dividend. So at a payout ratio of 128%, it's actually paying out 28 cents more than it's actually making. So that extra 28 cents is coming from cash reserves or debt. And if we have a look at the line there, which shows the dividends which are paid on an annual basis. So if we go back, it was, back 10 years, it was 35 cents per share. And now it's down to, 16, 18 cents now. So we can see that there's been no dividend growth because this business has not been reinvesting. If we go and have a look at CSL by comparison, it's got a very miserable 1.3% dividend yield and a payout ratio at 48%. So that means out of every $1 they make, they're paying out 48 cents as a dividend, and they keep the other 52 cents to reinvest back into their business. And of course, we've seen what happens from a growth point of view, but whilst the dividend is poor, we can see that the dividend that they're about to pay is $2.64, and it wasn't that long ago that the dividends were less than half of that, at around a bit under $1.30. So whilst the dividend percentage is not very good, over the last 10 years, the dividends they pay has actually doubled. So I would say that the dividend yield is a really blunt axe and it's just an arbitrary calculation. But the amount that they pay is more important. And are those dividends growing? Is profit growing? If it is, then dividends can grow. So I think dividend yield is a very blunt axe. Just looking for high dividends as a sole focused in retirement or investing in general is a very blunt axe. And there are businesses out there that are reinvesting heavily to make their products and services better over the long term, and that ultimately increases revenue and profit and increases dividends. So long video, but thank you for listening. I hope that's a help for someone, and just my take on dividends. You don't want high dividends, you just need high quality businesses. Thank you for listening. Cheers.